Hi friends, so today we are going to look at a dashboard for a VC ready model where we are going to look at a D2C company and try to see that how we can build a financial model for a D2C company. What is a D2C company? The D2C company means that it is direct to consumer. So what happens is that we will assume that let's say this company either sells food supplements or shampoos or anything where the method of acquiring consumers is through the website. So then there are a host of assumptions which are critical to the model's requirement. So one, we have the monthly website visitors in the terms of let's say how many visitors are there in each month, and then what is the year on year growth in terms of the visitors, what is the conversion rate, what is the average order value, how many of the customers keep repeating the purchase. So it could be 30%, 33% going up to 42%. We have cost of goods sold as a percentage of revenue. So what happens typically is that if you'll see the trend, it starts with 42% of revenue as cost of goods sold, and as revenues increase because of economies of scale, it falls down to 34%. And then you have the customer acquisition cost, which moves up from 520 falls to 5 480, 440, 400, and then 370. You also have, let's say, the customer's lifetime value, which is a metric that okay, if someone comes after spending a lot of money to acquire that customer, how much is the period for which that person remains in the company. Then we have the gross margin on repeat orders, which is again is a metric, and then how many of the orders get refunded and returns happen. Plus, in a D2C company, you will always have a fixed cost structure where you're going to spend a lot of money on the marketing and performance ads, on the logistics and fulfillment, technology and platform, and employee cost, along with general and admin cost. So these line items are there, and every year they will keep increasing. The idea that we have put them in yellow and blue is that these are all imputable by the user. So depending on what the entrepreneur feels about the business, this will always be there. And then we can say that okay, the company will also raise some money in funding, 3 crores in the first year, 15 crores in the second year, and then in the fourth year 50 crores. For the valuation module, we will also say that okay, what is the discounting rate which the user expects, then if someone invests in the company, at what return expectation will they discount the cash flows to arrive at the valuation of the company. What is terminal growth rate? Terminal growth rate is that in the last year where someone comes with a particular set of cash flows, beyond those explicit period, for posterity, how much is the percentage at which the company's cash flows will increase. We also have something called VC method. So let's say there is an IPO. At the IPO, the companies here assume that it will going to get a valuation of 4 times the revenue. The multiple on invested capital will be 10x and VC investment will be 15 crores. So these are all the imputable cells which the user says. On this basis, we can build a profit and loss account for the business. What will be the formula? The gross revenue will be the revenue on unit economics into revenue on unit economics. So first we'll have to go to this particular cell. So what happens is that in the first month of the first year, we have 50,000 users. So in that year, we will have 12,000, 12 into 50,000 is equal to 6 lakh users, which will go up to 50 lakh 40,000 users in the fifth year because the monthly number of visitors will be 4 lakh 20,000. The conversion rate will be 1.8, 1.2, and hence my total orders will be that whoever visits my company's website, 1.8% of that people are able to place an order. Then we have then order value, which has come from here where we have plugged in this number, and we also have a return and refund rate. So what we do is that 10,800 people place an order, which gets multiplied by the average order value of 1200. that gets multiplied by 1 minus 8% because 8% of that will be a return and a refund case. So 92% of that will get translated into my revenue, right? So that becomes my net revenue in rupees lakhs, and the similar formula goes for the final year as well. I've also said that, okay, from the this data, what is my customer acquisition cost in terms of my average CAC? How much am I going to spend for that customer? So that translates into that, okay, what is the average frequency of the order? So we say that, okay, it is 1.3, which means what? That this plus assumptions C10, 30% is the average. So that becomes 1 plus 30%. And therefore the average revenue per customer will be 1200, which is the average order value, into 1.3. The gross margin on this is 52%, 54%, 60%. The customer lifetime is value is 18 months to 20 months, and hence we have the customer lifetime value that, okay, this customer who places an average order of 1560 gives me a margin of 52% on that, stays for 18 divided by 12 months. So this becomes the lifetime value. So in D2C, you will get a metric which is lifetime value divided by CAC. And the higher the number, the better it is. So initially it is, let's say, 2.3, and later it moves up to 8.2x. So what is the CAC payback period? So it happens that, okay, I'm spending some money to acquire the customer. The customer is also giving me certain average revenue, and that multiplied by the gross margin, I can say that, okay, I am getting like the payback within 7.7 months, and later it falls down to 3.2 months. So the new customers acquired annually again will be a metric which will be 10,800 orders divided by 1 plus assumption C10, which is repeat rate. Okay. So I have my cumulative total number of customers. I have my gross profit, which is my total revenue, into 1 minus assumptions C13. Assumption C13 is the COGS as a percentage of revenue. So from 42%, 40%, 38%, 34%, it falls down. And my net revenue therefore will be this, and year on year revenue growth I can plot that, okay, it will be the first year's and the second year, the delta divided by the first year. For the formula for this will be E minus D divided by D. For every year it is going to be the same thing, that it will be, this is the revenue, and the growth rate will be F minus E divided by E. And similarly here it will be G minus F divided by F. So this becomes the revenue and the unit economics for this company. So then we have the P&L where we have the gross revenue which flew in from the unit economics sheet. So 120, 100 and this into C9 into C10, which is my average order values into average order value. So I am first showing my gross revenue, then I am showing the returns and refunds as a separate line item, which will be basically this gross revenue into the return percentage. So I get 119.2 lakhs as my net revenue, and that again keeps increasing year on year. I have already put that my cost of goods sold is equal to C8, which is my net revenue, into assumptions C13. So assumption C13, we have already said that, okay, this cost of goods sold will fall down from 42% gradually to 34% of revenue. Okay, so I have my gross profit, which is my revenue and COGS net of this, and therefore I have my gross margin for this year. Then you have seen that we have put in these 5 line items which are my fixed cost for the period. So that becomes like 138 is the total fixed cost for this period, and therefore the EBITDA is this minus this. Okay, in effectively, which means what, that I have to do plus here because I am considering all the expenses as already negative. Had I considered all of these expenses as positive, then it would have been minus as a sign. So I have my EBITDA, which is a negative 68.8 in the first year, goes to 71.3 in the second year, and then moves up to 517.7 in the fifth year. Then we have our depreciation. So depreciation we have assumed is, let's say, 2% of the revenue. This is just a flat assumption. You can also make it more complex by saying that okay, it will be linked to the balance sheet, the fixed asset block, and you can apply depreciation rates there, but that is not germane to the discussion as of now. We want to go with the flow and build a larger model. Now this company is assumed to be debt free at this model, so there is no interest income or expense here. So we have profit before tax, and then so the moment this all of it is negative, we also build a logic that okay, my accumulated losses is 17.1.2, moves up to 147.8, moves to 184.4, and then because I have a profit here, so it falls down to 57.1 negative. And in the next year, then when I have 478.4 as my profit, my taxable income becomes, after this set off, it becomes 421.3, and therefore I have to pay 25% tax on that. This is a very good logic that we can build here and understand how the financial model is able to accurately predict how the tax will be calculated. And therefore I have my total profit after tax, which is negative for the first 3 years. For the third year, I didn't pay any tax because the brought forward losses were good enough to set off. For the last year, I did some set off of losses, and then some I paid as an income tax. So that becomes my PAT margin. Now going to my cash flow. In the cash flow, what happens is we start with the profit after tax, which we get from the P&L account. Now in that, what happens, you add back depreciation, which is a basic concept of finance, that because it's a non-cash expense, it will always be added back. And then there is something called change in working capital, which we are going to build. In the change in working capital, what we say is that we have a balance sheet C8 plus C9 plus C10 minus 25, 26 and 27. So C8 is accounts receivable, C9 is inventory, and C10 is prepaid expenses. So what we do is that where we have an assumption that the accounts receivable will be the P&L C8. P&L C8 is the net revenue multiplied by 15 by 365. So I'm assuming that 15 days of my sales will always be as a accounts receivable. Similarly, my inventory will be on the basis of cost of goods sold. So this will be cost of goods sold is 50.1 into 30 divided by 365, and then prepaid expenses is my P&L into 2%. So therefore my total expenses are this. Total current assets will be accounts receivable, inventory and prepaid expenses. Now cash will come as a balancing figure from the cash flow statement. So here we are able to build the three items: accounts receivable, inventory and prepaid expenses. So for each of the years, with the same formula, we will be able to build this logic. Now similarly in the accounts payable, what will happen is that I will say that okay, it is 30 days of my P&L C12. P&L C12 is my cost of goods sold. So I am saying that okay, I am making it as 30 by 365 into the cost of goods sold. Similarly, my accrued expenses, I am saying that is just 5% of my P&L C8. So P&L C8 is net revenue. So I am just assuming that this will be 5% of my net revenue. And then I have my deferred revenue again, as assuming that 2% of my total C8, which is my net revenue, will be my deferred revenue. I have received money in advance. So this becomes my total current liabilities. This becomes my total current assets, but that includes cash also. So for the purpose of change in working capital, I will say C8 plus C9 plus C10, C8 plus C9 plus C10, and then minus C25, C26, C27. So it becomes accounts payable, accrued expenses and deferred revenue. So my cash flow from operations therefore will be my profit after tax plus depreciation and amortization and change in working capital, and therefore that becomes a formula through which I can get my cash flow from operations. We've also assumed that my purchase of fixed assets or capex will be 3% of the revenue. So what I'll do is that PNL C8, PNL C8 is my net revenue multiplied by assumptions C25. So assumption C25 is capex as a percentage of net revenue. I've assumed that it is 3% in the first 3 years and goes down to 2.5%. So that becomes my cash flow from investing activities. And then as we have seen that the company will raise 3 crores in the first year, 15 crores in the second year, and 50 crores in the fourth year, that also we will put as cash flow from financing activities. And hence my total cash flow will be my cash flow from operations, cash flow from investments, and cash flow from financing activities. So that becomes my net cash flow. We've also assumed that the company will start with 50 as the opening cash. So at the year end, my closing cash will be 278, which is my opening cash plus 226, 8.6, which is the cash flow for the year. Now this for the next year will be my opening cash balance for this year, will be the closing cash balance for the previous year. For each of these years, this same logic will apply. And my net cash flow for this year is this, and therefore I add it to the opening balance and get my closing balance. This closing balance goes into my balance sheet. So this completes the total current assets module. Again here in the balance sheet, I start with 50 lakhs as my opening gross block, and I do that. Okay, if I also have capex there, so I add this up, so it becomes, let's say, 53.6. And my accumulated depreciation for the first year, it is 2.4 that we had assumed as a percentage, and then it goes on in each year, and accordingly in the balance sheet my accumulated depreciation goes down, and I have my net block, which is my gross block less accumulated depreciation in each of these years as my total net block. And I have my total non-current assets, which are deposits, etc. In the starting also it was 5 lakhs, and we have assumed that it will remain the same. So my total non-current assets become 56.2. These 3 elements we have seen that we took 30 days of payables and accrued expenses and deferred revenue, etc. So my total current liabilities becomes this. My share capital, as in the beginning, I had what items? I had 50 lakhs of cash, I had 50 lakhs of gross assets, and 50 lakhs of non-current assets. So that means what? I had 105 of opening share capital plus assumptions C8 into 100 plus assumptions C29 into 100 plus C30 into 100. So what does this mean? Here, because this amount is all in rupees crores, I am just adding that into 100 and adding in my equity raised. My retained earning is my profit and loss account. So it becomes in the first year 71.2 and then 76.5 in the second year and so forth. It moves to 478.4. So it becomes the 478.4 is the for that particular year. So if you look at the cumulative amount that is earned, that will be there, and that is we build it here that for each year the figure will be the last year's cumulative retained earnings plus the PNL D35. Okay, so PNL D35 we have added in this year. Similarly in this year it is the last year's number plus PNL G35. So that we total add it up, and therefore my total liabilities and equity become this, and the check is that my balancing check is that my total assets and total liabilities and equity remain the same. So this comes as the PNL module, the cash flow module, and the balance sheet module. Along with this we will also have a valuation module here, very simple. So what we do is that, okay, I am earning a particular EBITDA in each of the years, which I am getting from my profit and loss account. Okay, so in a valuation, please always remember that it will start with EBITDA. So from there I am reducing my depreciation and amortization. I am getting my EBIT, and I get net operating profit after tax, accumulating this. So this is basically the same number as what is there in the profit after tax. So essentially the formula is that I start with my profit after tax and I add back depreciation and I reduce capex, because capex is a real outflow of cash. I add back depreciation because it is never a cash outflow, and therefore my free cash flow to to the firm will be this plus this plus this. Okay. Now, since my weighted average cost of capital is 28% in each of the years, my discounting factor is 1 divided by 1 plus 28% to the power 1. This is 1 divided by 1 plus 28% to the power 2. And this will be 1 divided by 1 plus 28% to the power 5. So what I do is that my free cash flow to the firm which is there, I multiply that by the discounting factor, and I get negative 56.6, 48.3, negative 20, plus 45.4 and 105.7. So my sum of the present value of the free cash flow to the firm is this. Then I also have a terminal growth rate. So my terminal year cash flow will be the last year's free cash flow into 1 plus 5%, because that is what I am assuming that it will grow in each of the years. And therefore, the formula for this will be the last year's cash flow, C22 divided by G17, which is my WACC minus terminal growth rate of 5%. So 28% minus 5% is 23%. I am dividing it by this. So it becomes 1658.2. Now this cash flow will be there for me at the end of 5 years. So for in today's terms, it will be 1658.2 into 0.2910. So that becomes my present value terms. And therefore my enterprise value will have two components. My first 5 years, whatever was the total of this is my first 5 years. The total of this comes here, plus my present value of the terminal value, the last year's number into 0.29. And therefore once I add both of this, it becomes the enterprise value. Okay. The other method to do it would be VC method, where I say that, okay, what is my year 5 revenue? My year 5 revenue is 1964. And what we have assumed is that if there is an IPO for the company, it will happen at 4 times the revenue for that period. So it becomes 4 times. So therefore the IPO for the company will be 7858.6, which is the 4 times of this number. The VC investment here is 1500 lakhs. So my required exit value for VC will be VC investments into multiple on investment capital. So my target VC return, which is 10x, is there because I am assuming that what did the VC invest in the company? The VC invested 1500, let's say, in this year. So that we can calculate. So the pre-money valuation today will be, again, whatever is the exit value divided by 1 plus 28% to the power 5. Okay, because this again is at the end of 5 years, this IPO value. So in today's terms, it becomes 22.87. So the implied stake for the VC will be that, okay, since the VC is investing 1500 lakhs, so the VC will expect 39 point. The terminal value plus the VC investment becomes the post money thing. So 31 divided by 34 plus 31. This becomes the value. Okay. So here what we started off with was a very basic summary dashboard, and so we could also build the whole thing in terms of a dashboard here in terms of KPIs. We started with assumptions around traffic and conversion, moved to unit economics, the cost structure related assumptions, funding related assumptions, discount rate, terminal growth rate, etc., and then move to the flow of revenue, the unit economics like CAC, lifetime value, and then the payback period, etc. And then we have the total P&L which we have built here, converted that also into a cash flow to get my movement of cash flow and closing cash balance, and that becomes the starting base for the balance sheet. And the best thing about the balance sheet is that it must tally. And so at the beginning, please remember that we had 50 lakhs of cash, 50 lakhs of fixed assets, and 5 lakhs of other current assets. So similarly, it started as 50 plus 5 as my initial share capital, and then whatever was the funding raise got added as share capital and premium, and retained earnings were the profits for the period. So I hope you had some basic understanding of how finance works here, and happy to answer your questions.